Science Breakfast with me, Alan Hubbard, and the sign language interpreter this morning is Chabiot. In studio, we are with Mr. David Gitau. He is the CCO of Lofty Koban. We are talking about capital preservation. And in the first half of this conversation, we spoke about the different schemes that exist in money preservation or capital preservation. We talk about your commercial papers. We talk about treasury bills. We spoke about money market funds and everything that you could be able to do to preserve your capital and income. But now we want to go into probably what would say the last half of this conversation, and we're going to be centering it around strategy and decision making. The first question would be, how should someone choose between these three options: deposits, treasury bills, and commercial paper?
Ideally, to put it into perspective, and this is essentially in the realm of financial planning.
Yes.
One should focus on understanding where they are from a financial perspective, from a social perspective, what kind of assets they have, what kind of debts they have, what is their income level, what kind of expenditures they have. But more importantly, or equally importantly, is to understand where they are going in terms of their dreams, their aspirations in life. And essentially, you then decide, as a third thing in the process, is you must assign an investment to each of these goals. We call that goals-based investing.
Yeah.
You must assign an investment to each of these goals. And the general rule is that for long-term goals, assign long-term investments. For short-term goals, assign short-term investments. So essentially what we're saying is these three investments are designed for short-term goals because they generate their returns quickly in the short run, 3 months, 6 months. So essentially the thing to decide is, when do I need this money? And then you can also decide, do I go directly or should I go through a collective investment scheme? If it is your emergency cash, of course, then when an emergency occurs, you need your cash on the spot. So it would not make sense for you to go directly and fix your money for 3 months, either with bank, government, or commercial paper. But then the strategy would be, why don't you put your money into a money market fund where you're able to liquidate on the spot?
Yeah.
The other thing, in terms of when you're deciding, there is this misconception, again, high risk, high return.
Yeah.
And this is, I'm going over and beyond the realm of just those three investments. There's this misconception about high risk, high return, because the relationship is high risk, high potential return, because the potential for losses are equally as high.
Yeah.
So one must really understand also their risk tolerance. A lot of Kenyans jump in looking at return
without calculating the risk.
However, risk is what drives return. So you must always understand the risk first before going to go and chase return. But as individuals, the most efficient way would not necessarily be going direct, because really, when you go direct, then you don't have any negotiating power. Like you mentioned, 100,000. Will the bank accept 100,000?
Yeah.
But remember, in a money market fund, the guy you can actually have 1,000 shillings, because to go and buy a T-bill, you tell the government essentially, I want to be paid 50K at the end of the period. But you may not have that 50K to even to start with. But in a money market fund, you can just enter with the others with as low as 1,000, others as low as 100, and you can even top up with 100 bob. And the beauty of going the money market route as opposed to going direct is that whether you have 1,000 bob, whether you have 100 million, you're all treated the same. You will get the same interest. You'll be able to access your money at the same time.
Yeah.
Okay? So essentially, by default, every Kenyan should have a money market account somewhere.
Yeah.
Yeah. It doesn't really matter. The choice should essentially be, what can they do for me? Because since they're all the same, what's the differentiating factor? What can they do for me that another asset or another sponsor would not be able to do? So when you look at it from a risk perspective, of course, treasury bills is the least risky. Then of course, then you have, you add fixed deposits, you get a higher return. And then of course, commercial paper, you have an even higher return.
Because the risk is higher.
It's higher, yeah. The other thing that investors should be aware of is they should not allow themselves to be duped. There are very many people, and there was even a warning from the Capital Markets Authority just the other day, that there are people who are peddling investments as money market funds. But the way to go about it is go to the website of the Capital Markets Authority and actually go to the tab that talks about investor protection. And go to the place that says licensees, click on that tab, and it will give you all the players who are licensed by the Capital Markets Authority, plus all the licensed products. So my advice is only deal with people who are licensed, and only invest in licensed products. I'm not saying don't invest in unlicensed products, because as it were, your collective investment schemes works on the same principles as a chama or an investment club. And your investment club is a collective investment scheme. The only thing is unregulated. I'm just saying
it's best of trust.
In terms of your due diligence, just go to the website.
And are there any specific life stages, businesses' needs, or financial goals where capital preservation is especially crucial?
In terms of life stages, and we'll deal with individuals first. In terms of life stages, the first place to start, of course, is a money market fund, because you need to build that foundation before you can add now risk. And the reason that is the case, because you need to first set your foundation in terms of issues like emergencies. Okay, you don't want to go and buy a piece of property, and we have seen very many people do that. They go straight into investments, buy a piece of property, an emergency occurs, they don't have cash. And then you're forced to sell that property at a significant discount to cater for that. So first, cater for your emergencies. Secondly, cater for your insurance. Okay, especially if you're the money-making machine, you must also protect yourself because you have dependents. So emergency fund and insurance. So that is basically a must for everyone. So irrespective of life stage, everyone should have a money market fund or some short-term investments which they can liquidate very easily. When you look at businesses, businesses have not really embraced the concept of money market funds. They just beginning to do that. Others have, especially the SACCO movement. But how businesses can actually utilize money market funds is one, in terms of their operational cash flows. There's usually a big crisis every end month among the small, medium enterprises.
Absolutely.
Everyone is running helter-skelter looking for salaries,
rent.
And rent. Yet, it is a very simple thing. What you can do with your cash flows, depending on how they come, whether they come daily, they come every 2 weeks, doesn't matter. You can just put money into a money market fund as a business, open a corporate account. At the end of the month, just withdraw and pay your salaries. But unfortunately, most business people and would tend to get money and buy stock. At the end of the month, they have money, but it is in the form of
stocks.
So if towards the end of the month the sales are low, then you are left in a crisis. The other thing that companies can do, and the SACCO movement has done this to perfection, is you can use a money market fund to accumulate dividends. So every month you put aside some cash, which you know probably after the financial year I will be able to pay dividends. That way you are able to even get or institute a kind of dividend policy, a stable business dividend policy, to avoid, again, at the end of the year, you want to pay yourself, you want to pay the shareholders dividend, but everything is in the form of stock. Again, then of course, very important, businesses must keep reserves just the way individuals do. COVID, again, was a stark reminder that businesses need to have cash reserves. Okay, just for unforeseen circumstances where things have gone haywire and you still have to pay rent, you still have to pay the basic staff who are probably providing security, you need to pay for cleaning the premises. So that is very critical in terms of that. Then you have businesses whose cash flows are also very erratic. Okay, they can always put and set cash in a money market fund, one, to increase income, to diversify their income, and to smoothen the volatility of their regular income. So there is a lot of space for businesses to actually put cash aside in money market funds. What I forgot to mention was for expansion or for taking advantage of opportunities that are out there. Cash by itself should always be seen as an asset class. Put cash aside. You are not too sure when you're going to use it, but when an opportunity arises,
you have a place to go to.
You have the money to do it. I think Warren Buffett and Berkshire Hathaway have used that to perfection. They always, at all times, have a cash buffer. It doesn't matter whether that cash will be there for 2 years, 3 years, but when the opportunity arises,
they are able to buy.
They are able to buy.
What are some of the most mistakes people make when trying to preserve their capital? And I think the mistakes are within what people are supposed to be doing, and they're not doing it.
The biggest mistake is not understanding that inflation is actually eating the value of their money. So when you're thinking of capital preservation, remember you also must preserve the value of that money. So wherever you put it, whether it is in a bank, whether it is in a money market fund, you must ensure that at least that value of your money in terms of the cost of living adjustment is maintained at the very least. So if, let's say, you go to the bank and they give you a rate, compare that rate with inflation. If you're looking at government, compare that rate with inflation. Wherever you go, compare it with inflation. And at least at the very bare minimum, it should keep tabs, but of course you always need that extra real return, because if inflation is at 8 and your return is 8, that means there's nothing for you. You've just
given them money.
You've just managed it to stay alive. So you need that extra 2 or 3%, which now becomes
the interest that you make. Can you talk about any hidden fees or taxes and timing risks that could reduce reduce expected return, even in safe investments?
One of the things is, and I'll not even call it hidden charges or anything like that, is that one, of course, any interest that you earn, whether it is in a fixed deposit, commercial paper, treasury bill, or in a money market fund, is subject
to taxes,
to withholding tax, or 15% of the interest earned. The only exception to that is if you are exempt from tax, either exempt directly by the Income Tax Act, or you have applied to KRA and you have a tax exemption certificate. This would especially be crucial, especially for majority of our viewers. As long as you have a tax exemption certificate, you will get the total return.
So those are the people who should even be running for these investments.
Precisely. Tax-free, as long as you have that certificate. So that's essentially what you should look out for. The other thing is, one of the things, like with banks and especially investing directly, where you have where your money is locked, if you have need for that money before it matures, of course there will be penalties, but
Yeah.
that depends on the specific entity that you have lent to. When we're dealing with money market funds, remember they are all the same. However, the one place that they differ is in terms of liquidity.
Yeah.
So whenever anyone goes to a promoter of let's say a money market fund, one of the questions that they should ask is, how often can I get my money? So you have funds which have restrictions. Some will say you can only withdraw once a month. Others will say you can do two free withdrawals. So if the guy who says you can only withdraw once a month will also have a clause where you say if you're going to withdraw a second time, there will be a small charge. It could be 500 bob, 1,000 bob. So that is one of the critical questions that you
need to ask yourself.
You need to ask. In terms of charges, typically the service providers, the trustee, custodian, auditor, investment manager, what they are paid is what we call management fee. To break down management fee as simply as possible is investors have been pulled into this scheme. That gives the service providers negotiating power to negotiate very good rates. So when they go to the market and they negotiate these rates and they get, let's say, 16%, the typical management fee would be 2%. So ultimately the investor would get 14% net of management fee. And that is what is usually published in the papers. Net of fees, but gross of tax. Okay, so that is the cost. When it comes to money market funds, when you're withdrawing money, there essentially are no costs. If you are withdrawing 1,000 shillings or 10,000 shillings, you will get exactly that amount in your account. So there are no hidden charges in terms of transfers when you're withdrawing. So there are no costs there. So that's, so in terms of costs, I think that's about it.
To wind down our conversation, some people or all people believe no risk, no reward. Is capital preservation seen as playing it too safe or too soft when it comes to investment?
It really boils down again to what goals you have. Okay, there are certain goals which need no risk. For example, emergencies.
You don't need any risk on emergencies.
So it is not about playing too safe. Every investment has its place within your goals. And so we go back to the goals-based investing strategy. So with your long-term goals, you don't really matter whether returns are negative, positive in the short term. You're interested at something else. So those long-term assets typically would have higher risk, so they have the potential to have higher returns. As for capital preservation, there are certain goals that they are very suited for. One is emergencies. Certain goals that are short-term, like maybe you're intending to do, let's say you want to go on holiday. You could actually either set up a travel fund or a holiday fund whereby you save mdogo mdogo, let's say for a period of 1 year. In December, then you go on holiday with the money that you've saved, or you can actually build it into some form of fund. So for example, if you build up your fund to about 1 million bob at a rate of about 12% per annum, at the end of the year you have slightly over 100,000, which you can actually just remove the interest and go on holiday. So it just depends on how you
remains there, generating you more money.
The other short-term needs that a money market fund or capital preservation would be ideal for would be issues like education, because you need school fees every 4 months. Two methods again: you can save slowly, or you can put money either directly for 3 months into a T-bill fixed deposit or whatever it is, knowing that by the time you're paying school fees, the money is available. Education-wise, again, you can do the same thing with, like we did with the travel fund, whereby you know, okay, every month I'm paying about, let's say, for example, 34,000 per term. So for me to effectively make my money work for me to pay 34,000, I needed to invest, let's say, 1,000,000 shillings every 3 months, withdraw the 34, no, every 4 months withdraw the 34, pay school fees. So it just depends on how you're looking at it. But let's look at it from this angle that capital preservation works best for short-term goals. Yeah.
Your last word from the conversation today?
Of course, again, just to reiterate that the biggest fear that we have, or the biggest risk as investors that we have, is actually not meeting our goals. And for me, being like the head of empowerment and advisory, it is always essential for you to have a plan. Okay? As Warren Buffett puts it, an idiot with a plan will fare better than a genius without a plan. Failing to plan is planning to fail.
Yeah.
So always have a plan, always write down your goals, because you need to understand where you are going. And that is very critical. Otherwise, you'll not know whether you even got there in the first place or whether you're in the right direction. So planning is very key, and I know at some point in time we'll be talking about financial planning, but it is high time we planned, lived within our means. Those small things like a budget, very important. Remember, being successful financially has nothing to do with your level of education or anything of that. It is all about behavior. And the biggest behavior that is important in investing is discipline. Discipline is having that investor mindset. Very important. Discipline, that consistency, very important. Other than that, I think, thank you very much for inviting me.
Yeah.
And I hope to see you soon.
Next Thursday.
Great.
Not even soon. Next Thursday, we are back with another segment in Money Matters and preserving and stretching the shillings that we have that are shrinking or that are being eaten away by inflation by the day. Yeah, that has been Mr. David Gitau. He is the CCO of Lofty Koban, and it has been Money Matters, and we've been talking about capital preservation. If you've missed any part in this conversation, go back onto our YouTube or Facebook. The conversations have been posted on there for you to be able to rewatch, learn, and garner some wisdom in terms of investment. What stood out for me is the meaning behind the name Lofty Koban. So go back to the beginning of the conversation and get to understand what the name means. I've been your host, Alan Hubbard, sign language interpreter Shebi Watt. Let us see you tomorrow on Friday as we